everybody, and welcome. As we like to do every week, we like to take a look at the past week's market activity and then kind of bounce around the market and look for something to trade. Well, what's been happening so far? Well, over the last few weeks, it's kind of gone nowhere, but the last few days of the week, especially Friday, was a big day, and the market went to, I think, all new highs or absolutely very near them. But essentially, it's been in a range for the last few weeks. Just broke out of that, let's say, in the last couple days, especially like Friday, Thursday, Friday were big up days. And of course, as we always like to look at the other indices, they look about the same. The Qs, again, the last couple days of the week went pretty much straight up. So it was kind of in this range for the last few weeks, just broke out of it recently. The Russell is the only one that's kind of lagging behind. You can see this one almost looks nothing like the other one. The other ones are at all new highs. This one has been tanking for the last few weeks when those were kind of in a range. And it also made a bit of a bump the last couple days of the week, but overall it's way below its all-time highs and lagging behind the other two indices. So what are we going to trade this week? Well, we're going to try something totally new because it's basically been a very beat up stock and it's very low price. I want to show you kind of something new. So this is natural gas. It's been tanking. You can see it kind of hit this recent high about 8, and ever since then it's been kind of bottoming out. It went as low as 450, then it shot way up here, but now it's kind of heading back to where it was before, and we're at about $5. So only 50 cents above its most recent low. And as far as volatility, you can see, except for this gap right here, it's pretty much where it's been, or as high as it's been over the last 6 months. This has obviously been a massive upshoot in volatility down here. Missed this one as far as like getting in, but I'm going to get into it now. But volatility is still pretty decent. Even though it's at 12, you can see except for this last couple of months when it just really tanked, it's still at a pretty good level. So what are we going to do? Well, this is a very cheap stock. So what we're going to do is we're going to buy a covered call. So what is that? That means we're going to buy the stock and sell a call against it. And I'm going to show you what that looks like. We'll go through a bit of explanation. I'm going to go here to the 54 days because they're more liquid. They're monthly options. And again, just more liquid. So what I do here is, it's pretty easy. What I do is I want to buy the stock, and I always want to sell a call directly above the stock price. So the stock price is 520. The strike price right above the stock price is $6. And you can see here it's going to sell for about 25 cents, let's say, roughly. The market's closed, so we don't know exactly. On this platform, all I do is I buy covered stock right here, and it does it all in one foul swoop for me. What it does is it buys 100 shares of stock at the market price, and it sells a call, the 6 call. And together it comes to $4.97. So what does that mean to me? Well, again, the stock price is $5.20. When I buy this, I'm essentially buying shares. My cost basis, because I'm selling this call, my cost basis becomes $4.97, which means over the next 54 days, if this stock continued to go down and it went down to $4.97, I would essentially break even. I'm buying the stock for essentially $4.97. That's my new cost basis. If it stays above $4.97, I make more money. If it goes below $4.97, I start losing money just as I would here, but I already have a cushion because it started at $5.20. I have this $4.97 cushion. So anything above $4.97 is profit. Everything below $4.97, I start losing money, whereas I would have lost money at $5.20 because if I just bought the stock outright without doing this covered call thing, that's my cost basis price, $5.20. The other thing I want to show you is, so what's the most I can make? What's best case scenario on this? Well, if I go here to confirm and send, you can see max profit is $103. How does that work? Well, I'm essentially buying this at $4.97. My sold call is $6. So what that means is if the stock goes above $6 in 54 days and closes there, my stock will get called away. Basically, I will be forced to sell my stock at $6. But what that means is the most I can make is the difference between what I'm buying this package for, or at cost basis, and the $6, which is $103. And how do I get that? It's the $6 strike price minus the $4.97 cost basis equals 103, which equals 103 bucks. Because again, everything is times 100. So $1.03 profit means $103 profit. So the reason I'm doing a covered call is, again, this is a low price stock, but also it's heading down, so it's at or near its lows. I'm selling this call on the hope that it goes up from here, but if it doesn't, my cost basis is below the stock price right now. So I've got a 23-cent, $23 cushion before I start losing money on this trade, which is nice. So my cost basis is lower than it is for stock. I'm capped at a max profit. If the stock shoots up in the next 54 days and closes above 6, the most I can make is 103 bucks. So that's the trade-off. I'm giving myself more cushion on the downside by limiting my absolute profit on the upside. If this thing shot to $10, of course, I lose that profit. But the reason I'm doing this is, again, my cost basis is lower. Again, my cost basis is $4.97 when the stock price is actually at $5.20, which means my probability of profit on this trade is higher. I already start down here. Anything above here is profit, where if I were to buy the stock today, I only make profit if it goes above $5.20. So you might need to watch this a couple times, but this is called a covered call or covered stock. We buy 100 shares, we sell one call at a strike price just above the stock price, and if things move in our direction, the most we can make is the difference between what we pay for this thing and our strike price. The most we can lose is anything below our new cost basis or the cost of this package, which is $4.97. So again, a couple things going on here, a new kind of trade, but something to look into. This is called a covered call. This is also something, just so you know, that you can do on any stock you have 100 or more shares on. If you have 100 shares on any stock at all, you can sell a call just above your strike, just above what the stock price would be now, and you can collect this money over, let's say, a 30-day period. You don't have to wait 54. I'm doing this for different reasons. But if you're trying to collect a monthly income, you can sell a call above the current stock price. If it reaches your stock price, okay, your stock gets called away. If it doesn't, you keep that premium and do it again the next month, and just do it again and again and again. This is kind of a income stream if the stock price stays in a range and never gets above your strike price. I know, again, a lot to absorb there. Might want to watch this a few times, but this is called a covered call, covered stock, and this is our trade in UNG for tomorrow. I am excited to let you know I've completed a book that is now available to everyone that wants to get it, called Learn to Trade in 7 Days. This is a book that will take you from absolute ground zero, as far as knowing absolutely nothing about options, all the way to trading them. Now, I'm so intent on getting this book to you because I really believe it is such a valuable resource for anybody and everybody that I'm going to offer an incredible deal on this, so stick with me on this. But before we get there, I want to show you what the book entails. The book is broken down into 7 days. Day 1 being, what is an option? You'll learn everything about options themselves. We'll compare stocks versus options. Then we'll get into basic option strategies like the vertical. And finally, we'll wrap it up with how to trade verticals, and then the making and managing of trades, which is, to me, the key to success long term above all. Now, as I mentioned, if you get into it now, if you go to this link, you can get this book for only $9.99. And I know that may not appeal to a lot of people because a lot of people aren't into books, but I'm so intent on getting you this book because I really believe it is such a valuable resource to anybody and everybody that I'll also throw in any one of my courses right here available on Udemy right now. So for only $9.99, you not only get the book itself, but you get one free course, which can be valued for as much as $100 depending on when and where you buy these courses. Again, just go to this link here and it'll take you to this page where, as you can see, you'll get the book and one of my courses for only $9.99. So really can't be beat. So again, just to reiterate, go to this link here. You will get my book, which you can hang on to forever, and I really believe is such a vital resource. I'm throwing in a course to really get you motivated to buy this book. That's how important I really believe this book is. The book and one of my courses for only $9.99 simply by going to this link. Please jump on this opportunity. It is something you really will be happy you did.